Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Sheila Bair, former head of the Federal Deposit Insurance Corporation, the FDIC, and now a senior fellow at the Center for Financial Responsibility. Sheila, nice to see you.
Nice to see you, Andy. Thanks for having me.
So, taking a step back, Sheila, what do you think the root causes are of the banking problems that we've experienced in 2023? Is it just higher rates or more than that?
Well, it's rapidly increasing rates combined with a basic lack of interest rate risk management. It's not exactly a secret that this was coming. And it's not exactly a secret that, financial assets lose value when interest rates go up. So we've had a really long period of ultra low rates. We've had fairly good bank earnings, very few bank failures. I think people got a little complacent. But I do feel that the recent banks that failed were outliers. There were some pretty fundamental mistakes in bank management, and the supervisory process also had some opportunities for improvement. But that's, rising rates. You got to focus on your interest rate risk when rates are going up as quickly as they have been.
So how careful does Jay Powell have to be now, Sheila, with regard to raising rates?
Well, I think he needs to be very careful. I had actually, in a piece I think you helped edit, written last December that I thought he should hit pause on rates. Look, I'm an inflation hawk. I think they need to prioritize inflation fighting, but they can only do so much so fast. We had, nearly 14 years of ultra low rates and some fairly significant inflation in the past few years taking hold. And they need to address that. They can only go so quickly. And when you have this huge buildup of leverage, which we have, a lot of inflated asset valuations combined with a lot of leverage, and those are the kinds of incentives that are created when you have low rates, the economy and the financial system can only absorb so much. So I do think it needs to be careful. And hitting pause is not retrenching on the battle for inflation. It just means hitting pause is, okay, we've done a lot very quickly. Let's assess, see where we are. The worst thing that could happen would be to have a very hard landing. The Fed takes rates back to near zero again, and we just start this whole cycle all over. We go through the pain of higher rates of a recession and still have not conquered inflation. So I think that's the worst. And hitting pause, being on a more sustainable pace and glide path is far better than going too quickly and then having reverse course.
Even though you're suggesting that higher rates is the primary reason that we've had some issues in banks, and I'd love to talk to you about that a little bit. For instance, what about insuring deposits? Where do you stand on that?
Well, I do want to make clear it's higher rates combined with lack of interest rate risk management. These are risks that can be managed. And so I wouldn't want to say just as high rates. It's a combination of the two. But yes, it has shown that, and again, this is nothing new. When you get into periods of financial uncertainty, uninsured deposits are not stable. They run. We saw this during the great financial crisis. We're seeing it again today. There are tools that can be used to manage that. Unfortunately, one of the key tools that the FDIC used during the great financial crisis, which was to provide a temporary backstop on transaction accounts, which are very important to the functioning of the economy. We had done that. We had powers through a systemic risk determination, which required supermajorities of the Fed board, our board, the Treasury Secretary, the President, all approving this. But we were able to launch a temporary guarantee of operational accounts. For whatever reason, Congress decided to take that authority away in Dodd-Frank. And so now that you need to get congressional approval, there's a fast track procedure, but it's not been initiated by the president, who needs to request it. But these transaction accounts, I think there's a case actually to providing a permanent guarantee. They do that in Japan. These transaction accounts are important because these are basically the lifeblood of the business customers of a bank. It's money they use to pay bills, to make payroll, bring the revenues in, pay their expenses. The money's constantly going in and out. It's very difficult to move them because they're all tied in with the bank customers' own systems. But they're inevitably above the insured limits. There's not really much the business customer can do because you've got a lot of money's flowing in and out constantly. And when a bank fails, then the businesses, and it's also nonprofits, local governments use them too. they can't stay in business. They can't access the funds they need to operate. So there's a good reason to provide protection for them. In Japan, the requirement is zero interest. We had a similar requirement with our temporary zero or very, very low interest, because you don't want that unlimited guarantee being gamed for just, high yield deposits. It's worked well in Japan. It worked beautifully during the great financial crisis. I think it's something that they need to do now. Maybe perhaps consider making a permanent guarantee. That's all I would do. I certainly would not provide universal deposit insurance guaranteeing everything, all deposits. That could result in a lot of distortions and moral hazard. Weak banks would take that universal unlimited guarantee and offer really high rates to bring in money, to make reckless bets, so to distort the flow of money. So if you had unlimited guarantees on deposits, and the FDIC backs those, and that full faith and credit of the United States is behind the FDIC, you would probably see a lot of money coming out of the short-term treasury market, out of government money market funds, into the convenience of a bank, and that would also create some distortion. So I think that is a very bad idea, but unlimited coverage of transaction accounts is a good idea.
Our transaction accounts, a couple follow-up questions. Transaction accounts, but I understand that with a hardware store. But what about with Apple? I mean, their payroll account must be many millions of dollars, hundreds of millions of dollars. Are you suggesting that we should insure that as well?
So first of all, my guess is Apple has, to the extent, they probably have a number of bank accounts. And my guess is most of their banking is with the so-called too big to fail institutions. So we're kind of already guaranteeing that already, to be honest with you. But yeah, I mean, I think you could cap it. The problem with the cap is that where do you set it? So for instance, if you're just trying to help this, there's super small businesses and super small nonprofits, well, maybe a couple million would it be a cap. But even for the smaller ones, like I'm on the board of nonprofits, even smaller ones, they can get multi-million-dollar grants that will temporarily move through their checking account, their operational account, before it gets into their investment portfolios. So that uncertainty, I think, would still create instability. You also, you probably want the regional banks to be competitive with JP Morgan Chase or Bank of America for the Apple accounts, right? They would like to serve those customers too. But again, if you put a lid on it, because you don't want to help the super big banks, all that's going to do is just to the extent it's not already there, it's just going to put it into the so-called GSIBs, which unfortunately are still viewed as too big to fail.
And you wouldn't raise the threshold from above 250K?
No, because listen, for households, that is more than enough for Main Street households. And actually, you can get over $1 million even in a single account through account structuring, and you need to be careful in how you do that. There's some very good tools on the FDIC website. So you can get significantly more than $1 million through account structuring. Your family, a household can, if you needed to. So the current rules are more than adequate for Main Street households. If I could just go back to your Apple question too, which was a really good one. I do also want to point out that these should be zero interest bearing. So you're not going to have to worry about anyone, large or small, putting a lot of money in it just to game the unlimited coverage, because they're not going to get a yield off of it. They're going to, it's somewhat self-limiting. They're going to put in as what they need to put in to cover their operational expenses. And that was the experience we had during the great financial crisis as well.
You mentioned to me, Sheila, that you want to impose long-term debt requirements on regional banks. Explain that. And wouldn't that be too expensive for these banks?
I do think if you're talking about protecting uninsured, a way to promote market discipline and still help protect the uninsured is to have more loss absorption below those uninsured accounts if a bank fails. So, in the FDIC resolution process, same as a bankruptcy, there's an order of priority of who gets to claim, assets, equity, preferred equity, sub-debt, long-term unsecured debt is all subordinate to uninsured deposits. So if you increase that cushion, you're going to provide the uninsured depositors more protection and dramatically reduce the chance that they would even suffer losses if their bank failed. Now, there are different ways you can go about doing that. The regional banks, so the GSIBs, the very largest banks, what we call GSIBs, already have this requirement. But the regional banks argue that they can actually issue it at very low rates because everybody views them as too big to fail. The regionals are small enough to fail. So I think there are some ways to do it. One, you could maybe have lower requirements for them. but you could use somewhat of a carrot and stick approach. So for instance, one of the things I did with FDIC insurance premiums when I was at the FDIC was we instituted a risk-based premium structure, and we gave credit for banks. They got a reduced premium if they had a lot of long-term unsecured debt. You could ratchet that up and provide a lot of better incentives, but you also have penalties for the ones that don't have it. You could also maybe calibrate it so it's more severe for the regional banks that have, hot money, hot deposits. So, unstable, uninsured, or even insured can be hot. If it's just brokered, it's just there for the high rate. There's no other customer relationship. So I think some combination of deposit stability and a carrot to stick through insurance premiums, you could get there in a way that wouldn't be too onerous on the regional banks. And I am sensitive to that because I care about the regional banks. They were heroes during the great financial crisis. They kept lending. Community banks kept lending. We need them. They're huge lenders to the more small and medium-sized businesses. So we don't want to do things that are overly punitive. But it will be in their interest if we can find a cost-effective way to give uninsured depositors more confidence in doing business with them. And I think unsecured debt is part of the solution there.
Sheila, couldn't you make the argument, though, that we have too many banks in this country, 4,100 banks? Canada has 80 banks, okay? They're about 10% the size of us in terms of GDP and population. Still, the numbers are not commensurate. Don't we need less banks?
We don't really have that many regional banks either. If you count the mini regionals, but 100, maybe a little more. So when you get into that 4,100, you're really talking about community banks. Those are, certainly less than 50. I usually define community banks as less than 10 billion. So yeah, no, I'm sorry, we need them. It may be harder to supervise them. There's so many of them, but almost always when we have a crisis, it's the larger institutions that have been creating the problems. It's not the community banks. And we have to have this conversation each time. Do we have too many banks? But the community banks are almost always part of the solution. They're not part of the problem. Some of them do fail. We had some that failed during the great financial crisis, but as a percentage of the number, it was very, very small. And they do. I'm from a rural area. They are in there serving communities in these small town rural areas. You get a big bank branch, they're having to go thousands of miles away for approval probably or something. They're not necessarily, the senior decision makers are not going to know the community. You call them, you maybe get an automatic voice trying to help you as opposed to being able to call up the bank president, which I can do when I need to. And that's independent of whether I'm a former chair of the FDIC or not. You just get that high touch banking that I think is really valuable, especially in smaller communities. So yeah, and we have, we're a lot bigger country. We're a lot bigger economy than Canada. So I've heard that question a lot over the years. That's not to say we can't improve supervision, but we need those community banks. And that's the lion's share of that 4,100 you're talking about.
All right, I'm glad you mentioned supervision because we need to talk about that. I mean, the regulatory oversight, if you look at it in terms of graphs, it's a rat's nest. What should we do and what can we do? What's realistic in terms of reforming the regulation environment?
Well, first of all, when something like this happens, we need to ask, is this a problem that we need more rules, or is this a problem that we had rules that weren't enforced, or maybe we had too many rules or rules that provided the wrong incentives? And I kind of think it's the latter, the case here. First of all, there are already rules around, interest rate risk management is just fundamental, matching your assets and your liabilities, managing the risk around duration mismatches, and you're inevitably going to have duration mismatches. That's part of what the banking models are like. So, first of all, management didn't do their job. Supervisors could have done a better job. So let's think about that. Maybe we need to empower supervisors instead of layering on more requirements for them. Just give them better support. Let them escalate more quickly when findings are not remediated. I like economic incentives as a better approach to regulation than these prescriptive rules that end up being thousands of pages long. If a bank's not remediating, maybe they just don't pay executive bonuses until they do. Maybe they just don't, make shareholder distributions and they do. Provide some, incentives as opposed to more rules and restrictions on supervisors. Provide them more powers that align economic incentives to get those problems remediated. I do think the rules now are hideously complex. Both the risk-based capital rules as well as liquidity rules are hideously complex. It's hard for even senior managers and boards of directors to really understand. And they also provide powerful incentives to invest. Guess what? Invest in long-term government debt, which is exactly what Silicon Valley Bank did. Again, that's not to excuse their lack of interest rate risk management, but the liquidity rules, you could have deeply underwater, long dated government backed securities, and they're still going to be treated as zero risk under the risk-based capital rules and as highly liquid under the liquidity rules, even though they are anything but. So regulators should think about removing some of these perverse incentives, or if we have new rules, let's fix the rules that we have, and fewer rules. The stress testing and resolution planning that we put on banks now, and this is a debate about whether there should be more of that with the regional banks. Yes, but on a very simple, basic level. I mean, what is JP Morgan Chase's resolution plans? What, 20,000 pages long or something now? And the stress tests don't even stress reality. Our stress tests wait for it, our stress tests here in the US, unlike Europe, our stress tests do not stress a high inflation, high interest rate, high unemployment scenario. That's a scenario everybody's worried about. We don't even stress it. And to his credit, JP Morgan Chase CEO Jamie Dimon has called this out. Even the banks are saying you need to stress higher interest rates in the stress test. So again, to the extent they become a distraction, or even worse, give boards a false sense of security. Oh, we passed the stress test. Well, the stress test isn't reality. That's something that regulators need to fix. So I do think more reliance on economic incentives, simplifying the rules, removing the perverse economic incentives that are built into some of the rules now. And then if we're going to have stress tests, make them simpler and make them reflect the real world.
Shifting gears, Sheila, you've written a number of books for children about money, markets, and the economy, including 2 new ones coming out this fall. Money Wizards, a story about inflation, and I love this one, Daisy Bubble, about
Yes.
speculative asset bubbles. Do kids really want to read about this kind of stuff, Sheila?
I met with skeptics when I first started. My books, they're funny and they're humorous and they have happy endings, so they don't scare anybody. But they're about, financial risk that are out there. And yeah, I mean, the ones I've written so far have done pretty well. And I think kids need to learn that. It's certainly basics, inflation, too much money, chasing too few goods. Yep, you know what? Kids can get that. And I illustrate with the story about a little princess and money wizards who, she wants to go on an expensive vacation and her friends can't join her, and because they can't afford it and dad's away on business. So she just tells her money wizards in the castle to just start printing more money. And of course, you have the projectile inflation because the supply can only grow so fast, where the money supply can grow really fast if you turn on the spigot. So yeah, kids absolutely get that. And parents love the books too. And then
Right.
Daisy Bubble is kind of a riff on the tulip bubble in Holland. And it's about a Floriana daisy bubble on the Galapagos Islands. Some of my fantasies are based there. But yeah, I mean, getting this kind of psychological buy, because the price is going up, and buy some more. Yeah, kids can get that too. And they need to learn it early. So yes, thank you for asking the question. I know a lot of people are skeptical, but they absolutely work. And kids like them and parents like them too.
And final question, Sheila, how do you balance, big question, free markets on the one hand and protecting consumers on the other?
There's a difference between free markets and free for all markets. So you need some basic consumer protection and regulatory oversight. There's no doubt about it. But again, making sure those rules are simple, easy to understand, easy to enforce, and transparent to consumer too. A lot of the consumer regulation, though, I think this has gotten better with our new Consumer Financial Protection Bureau. They don't really understand what their rights are because even those rules can be very complicated. So I do think, look, properly aligned. This is why I still believe in market discipline. I still believe in accountability. A company, whether it's a bank or anybody else who's putting a bad product out there, word is going to get out, and the market itself will discipline that entity. And what the best thing is to make sure there's transparency and simplicity around explaining that product to consumers, and that's a horrible problem in financial services. They overcomplicate. There's so many tricks and traps that are non-transparent, but that's where I would focus, where I've always focused. And then financial education, which cannot replace regulation, but it can complement regulation. But yeah, we need strong rules, keep them simple, keep them enforceable, keep them understandable by the consumer. and emphasize transparency so the consumer knows what they're getting. The consumer is going to be the best judge of whether that product is good for them, so long as they have the information they need. And that's really the trick.
Sheila Bair, former chair of the FDIC, thank you so much for your time.
Thanks. Happy to be here.
You've been watching at Barrons. I'm Andy Serwer. We'll see you next time.